Myself is Ramesh TN, second semester MCom, Government First Grade College, Arts, Science and Commerce, Sira. Department of Studies in Commerce. Subject is Advanced Financial Management. Topic is Asset Liability Management in Banking. Going to Introduction of Asset and Liability Management in Banking. Asset and Liability Management, often observed. Asset liability management is the practice of managing financial risks that arise due to mismatches between the asset and liability as part of an investment strategy in financial accounting. Asset liability management sits between risk management and strategic planning. Now to meaning of asset. Asset is an property which is used to generate the revenue and which is owned by the business organization. Types of asset. Types Two types of asset. First one, fixed asset. Second, current asset. First one, fixed asset. They are held on long-term basis in a business organization is more than 1 year. Example, land, buildings, machinery, plant, furniture, goodwill. Next one is current asset. There are the assets held on short term less than 1 year in the business organization. For example, debtors, bills receivable, stock, cash, etc. Next one is meaning of liabilities. Liabilities are obligations or debts that an enterprise has to pay to sometime in future. Types of liabilities. First one is long-term liabilities. Long-term liabilities are those that are payable usually after a period of 1 year. For example, loans, debentures, etc. Second one is short-term liability. Short-term liability are payable within a period of 1 year. For example, creditors, bills payable, bank overdraft. Next one is importance of asset and liability management in banking. First point is balance sheet stability. Asset liability management ensures that a bank's assets and liability are in sync, preventing liquidity mismatches and maintaining stability. This balance is vital for the bank's day-to-day operations and long-term sustainability. Next point is risk management. Asset and liability helps banks identify, assess and mitigate various risks including interest rate risk, liquidity risk, credit risk and market risk. By actually managing their risk, banks can protect themselves from potential loss and financial instability. Next point is profitability of optimization. By strategically allocating resources and managing the mix of asset and liabilities. Asset and liability management helps banks optimize profitability. It allows them to maximize returns on assets while actually managing the costs associated with liabilities ultimately driving sustainable growth. Next point is regulatory compliance. Regulatory compliance. Banks operate in a highly regulated environment, and asset liability management plays a cultural crucial role in ensuring compliance with regulatory requirements by adhering to regulatory guidelines and maintaining sound asset liability management practice. Banks can avoid penalties and maintain their reputation in the financial market. Next point is strategic decision making. Asset liability management provides valuable insights that inform strategic decision making process within banks, whether it's expanding into new markets, introducing new financial products, or adjusting pricing strategies. Asset liability management data and analysis help banks make informed decisions allocated with their long-term objectives. Next one is scope of asset and liability management in banking. First point is liquidity risk management. One of the primary focus of asset liability management is managing liquidity risk. This involves assigning the bank's ability to meet its short-term financial obligations, maintaining an adequate liquidity buffer, and developing strategies to address liquidity shortfalls. Next point is interest rate risk management. Asset liability management assesses and manages interest rate risk, which varies from changes in interest rate affecting the bank's assets and liabilities. It involves monitoring and controlling the impact of interest rate fluctuations on the bank's profitability and net interest income. Next point is fund transfer pricing. Fund transfer pricing is a key component of asset liability management, helping banks allocate cost and profit to different business units and products. It ensures that the pricing of loans, deposits, and other financial instruments reflects the underlying cost of funds. Next point is balance sheet structure and optimization. Asset liability management examines the composition of a bank's balance sheet, including the types of assets and liability held there, maturities, and interest rate sensitivities. It aims to optimize the balance sheet to align with the bank's risk update, update and profitability goals. Next point capital management. Effective capital management is integral to asset liability management. Banks must access their capital adequacy, adequacy and allocate capital to support business activities while meeting regulatory requirements. Next point strategic planning. Asset liability management contributes to the bank's strategic planning by aligning asset liability management strategies with the institution's overall goals and risk appetite. It helps guide decisions related to business expansion, product offerings, and risk management. Thank you.